All right, so we're ready to dive into the fascinating world of convertible securities and warrants.
Oh, absolutely.
And for this deep dive,
Yeah.
we're turning to, you guessed it,
hmm
Benjamin Graham's The Intelligent Investor.
Classic.
Yeah, and we're focusing specifically on a chapter that delves into this intriguing area of convertible securities and warrants.
Yeah.
Now, I gotta say, what struck me was that Graham actually dedicated a whole chapter
I know, right?
to this topic,
Back in the day.
way back when,
Yeah.
and even went so far as to call out stock warrants as a potential disaster.
Yeah, potential disaster. I mean, that's pretty strong language.
Strong words.
Yeah. Clearly, this stuff has been around for a while.
Oh, yeah.
And, it's really key to understand it, especially in a volatile market like we're seeing today.
Exactly. I mean, these things are still relevant today.
Absolutely.
So it sounds like we're on a mission here to uncover the truth behind the allure
Mm-hmm.
and potentially the illusions surrounding these convertible bonds. Yeah.
Preferred stocks
Right.
and warrants.
It's a journey for sure.
Yeah. And who better to guide us than the father of value investing himself?
The OG, Benjamin Graham, that's right.
Exactly.
So to kick things off,
Yeah.
let's just kind of level set here, make sure we're all on the same page.
Okay.
So convertible bonds and preferred stocks, right?
Yeah.
They're kind of like, I don't know, like the chameleons of the financial world. You know what I mean?
Yeah.
They offer that, like, that security that you expect from traditional bonds or preferred stocks, right?
Mhm.
But they have this kind of like, I don't know, like this hidden superpower,
Ooh.
this ability to transform into common stock
Okay.
if the conditions are right.
Interesting.
So it's kind of like you get the stability of
Yeah.
fixed income, right?
Right.
But with the chance to, catch that growth wave if the company's stock just takes off.
So it's like you get the best of both worlds, right?
That's often how it's sold, right?
Yeah. It's like, oh, you get your cake and you get to eat it too.
Exactly.
But Graham,
Yeah.
he kind of throws some serious shade, throws some doubt on that whole win-win idea.
Oh, really?
Oh, yeah. He's like, hold on a second.
Okay.
Let's not get too carried away here.
Right.
He reminds us that no financial instrument, no matter how fancy or how clever,
Mm-hmm.
guarantees success.
Right.
It's just not how it works.
Of course. Of course.
The real value of a convertible, he says, lies in the details.
Right.
The nitty-gritty details of the issue
Yeah.
and the prevailing market conditions at the time.
Interesting. So it's not as simple as just, oh, this is a convertible, it's going to be great.
No, no, no.
You got to dig deeper.
You got to do your homework.
Look under the hood.
Absolutely.
So hold on, though.
Yeah.
If this were truly this win-win scenario,
Yeah.
wouldn't everybody be jumping on these things?
You would think, right?
I mean, there's got to be a catch.
Yeah.
Or at least some nuance that we're missing here.
You're absolutely right. And that's where the issue of timing comes into play,
Okay.
which, according to Graham, is often, well, it's often misaligned with the market. Let's just say that.
All right, so let's break this down. So why would companies choose to issue convertibles when the market is already, soaring?
That's a great question.
And why is that a bad sign for investors?
Well, during those like euphoric bull markets, right?
Yeah.
Everyone's just feeling super optimistic.
Mm-hmm.
And companies, well, they can kind of capitalize on that sentiment.
Oh, I see. I see.
They can secure funding at more favorable terms.
Okay.
They dangle that promise of potential upside from the conversion,
Oh,
right?
yeah.
Which can then in turn lower their borrowing costs.
Right.
But here's the crucial part.
Okay.
If the market takes a downturn,
Yeah.
that allure of conversion,
Uh-huh.
it fades pretty quickly.
It's like buying a luxury yacht.
Yeah.
Just as a recession hits. Suddenly, that status symbol
Right.
becomes a financial burden.
That's a perfect analogy.
Yeah.
You nailed it.
So the data actually backs this up.
It does.
These convertibles that are issued at market peaks, they often underperform
Exactly.
because the underlying company
Yeah.
may actually struggle as the market weakens.
Yeah, the fundamentals start to shake a little bit.
impacting the value of both the bond
Mhm.
and the potential for stock conversion.
And that's where it gets tricky.
So investors kind of get caught up in the hype. They're thinking they found this amazing deal.
The fear of missing out, FOMO.
Yeah, but they haven't really factored in
Right.
the very real possibility of a market downturn.
The what if.
It's a classic case of
Yeah.
what behavioral economists call irrational exuberance.
It's a real thing.
I mean, we've all been there.
We all have.
We get excited.
Oh, yeah.
We don't think things through.
Absolutely.
And Graham, he actually uses a really powerful example to illustrate this point.
Oh, yeah.
The story of Eversharp Co. convertible debentures.
Ah, ever sure.
It highlights how even seasoned investors, the ones who have been around the block,
Yeah, the pros.
the pros, can be blinded by
Market enthusiasm.
market enthusiasm and can actually convert
Oh, yeah.
at the absolute worst possible time
At the peak.
and suffer substantial losses.
Oof, it's a tough lesson.
Yeah, so talk about a cautionary tale, right?
Big time.
It seems like timing the market is nearly impossible.
It is. It really is.
And these convertibles issued during peak periods
Yeah.
might be especially susceptible.
Oh, yeah, they're right in the crosshairs.
Yeah, to those timing pitfalls.
Mm-hmm.
But I'm curious,
Yeah.
what about Graham's advice to never convert a convertible bond?
That's a good one.
It seems a little extreme, right? Wouldn't you want to convert if the stock is doing incredibly well?
You would think, right?
Yeah.
But that's where Graham's, that contrarian thinking
Yeah.
really shines.
Okay.
He argues that holding on to that convertible bond,
Mm-hmm.
especially when the stock price dips,
Yeah.
it provides a strategic advantage.
All right, explain this to me like I'm a newbie investor.
Okay, newbie investor.
Why would I choose to be a bondholder
Yeah.
while everyone else is seemingly making a killing
Right.
in the stock market?
It's a good question. So think of it this way.
Okay.
You've got an escape hatch.
Uh-huh.
If the market turns sour,
Okay.
you have the option to ride out the storm as a bondholder,
Right.
enjoying that steady interest income.
Okay.
Or you can choose to convert.
Right.
If and when that stock rebounds,
Mm-hmm.
capturing some of that potential upside.
Yeah.
It's all about maximizing your flexibility
Yeah.
and minimizing that risk.
Okay, so it's like having a backup plan
Exactly.
in case things go south.
A safety net.
Right, but
Yeah.
Graham doesn't stop there.
Oh, no, he keeps going.
He also emphasizes the importance of digging deeper,
Yeah.
looking beyond the hype.
Peeling back the layer.
Yeah, surrounding these convertible issues.
Mm-hmm.
He stresses the need to really scrutinize the fine print.
Absolutely.
What's the underlying security like?
Yeah, what are we really dealing with here?
Is the related common stock
Right.
truly attractive?
On its own merits.
Yeah.
You got to ask that.
On its own.
Yeah.
Don't get swept away by the conversion story alone.
No.
You gotta make sure fundamentals.
Yeah, the fundamentals are solid.
Have to be.
It's like buying a house based solely on, the fancy staging
Oh, yeah.
without checking for, structural issues.
Yeah. Right, or the neighborhood.
Or researching the neighborhood, yeah.
Is it safe?
Exactly.
Are there schools nearby?
Exactly. And
What about those property taxes?
and remember those seemingly win-win AT&T convertible bonds
Oh, yeah.
we mentioned earlier?
Well, upon closer examination, it becomes evident
Yeah.
that the scales might have tipped
Mhm.
slightly
Yeah.
in favor of the issuer over time.
It can happen.
So even in a seemingly balanced deal,
Right.
there can be these subtle nuances
Always.
that benefit one party
Yep.
more than the other.
More than the other.
It's like agreeing to split a pizza with a friend,
Yeah.
but you only get the crust.
You get the credit.
And they get all the good stuff.
All the toppings.
Yeah, all the toppings.
That's a great way to put it.
all the cheese.
All the cheese. Yeah.
Now let's move on to another
Okay.
crucial factor.
Right.
Investors need to consider
Yeah.
the potential for dilution.
Dilution. Ah, yes.
Okay, help me visualize this.
Okay, let's paint a picture.
What does dilution actually look like in practice?
In practice. All right. So imagine a company
Okay.
with 100 shares outstanding,
Mm-hmm.
each earning $1 in profit.
Okay.
So that's $1 in earnings per share, or EPS as they call it. Now, let's say they issue convertible bonds.
Yeah,
That could potentially convert
right.
into 50 new shares.
So now you potentially have 150 shares
Right.
fighting for that same
Yeah.
$100 profit pie.
Exactly.
Okay.
So if all those bonds were to convert,
Mm-hmm.
the EPS would drop to about 67 cents.
Oh, wow.
Now, apply this to a real-world scenario.
Okay.
If you're holding common stock in a company
Yeah.
that issues a ton of convertibles,
Mm-hmm.
your ownership stake
Right.
and potential earnings get diluted
Okay.
when those conversions happen.
It's like inviting a bunch of people to a party
Oh, yeah.
where you're providing all the food and drinks,
Right.
and suddenly your resources are stretched thin,
Yep.
and everyone gets a smaller piece of the pie.
Smaller piece of the pie. That's it.
Yeah.
And, Graham, he warns us about companies
Mm-hmm.
particularly these big conglomerates, right?
Yeah, big guys.
Using convertibles to engage in what he calls convertible ledger domain.
Convertible ledger domain. That sounds fancy.
It does, doesn't it?
What does that mean?
Well, it's essentially creating an illusion of higher earnings.
Oh, okay. So it's like they're trying to make the punch bowl look fuller
Yeah,
by adding more cups
Yeah.
without actually adding more punch.
exactly.
So it's all smoke and mirrors.
Smoke and mirrors.
Yeah.
And the source actually provides some real world examples, like the NVF Corp
Mm,
and Sharon Steel Co. deal
okay.
to show how this tactic can play out.
Okay, so this is a real thing.
It is a real thing.
It's not just theoretical.
Oh, no.
This is actually happening.
This is happening. Plus, there's a table in the book
Okay.
listing companies with massive amounts of stock,
Wow.
potentially issuable through conversion or warrants,
Okay.
highlighting the scale of this
Yeah.
potential dilution problem.
So it's a real issue
It's a real issue.
that investors need to pay attention to.
You got to pay attention.
It's a stark reminder. Big time.
That we need to look beyond the surface
Mm-hmm.
and really understand
Yeah.
the potential impact of these convertible securities
Right.
on a company's earnings
Absolutely.
and our own ownership stake.
And yours. Exactly.
But before we move on to warrants,
Yeah.
I have to ask about something that caught my attention earlier.
Okay. What's that?
Graham mentions this historical shift
Yeah.
where common stocks
Mhm.
used to yield more than preferred stocks.
Right. Interesting.
Yeah. But that flipped in the late 1950s.
Mhm.
What's going on there?
Yeah. What happened?
And how does it relate to convertibles?
That's a keen observation.
Yeah.
It's a good catch.
I was reading the book and I was like, wait a minute,
Yeah.
what's going on here?
So this shift actually opened up a really interesting opportunity
Okay.
when the dividend yield on a convertible preferred stock,
Yeah.
it surpasses that of the common stock.
And considering the preferred stock's senior position in the company's capital structure, right?
Yeah.
A switch could actually be advantageous.
Okay. So instead of chasing the higher potential growth
Mm.
with the common stock,
Yeah.
you might actually be better off going for the higher, more stable dividend income.
Right. That steady income.
Than added
The
security
safety net again.
of the convertible preferred stock.
Forgot it.
Okay, so it's like finding a hidden gem
Oh, yeah.
in a vintage shop.
I love that.
Something valuable that others have just overlooked.
Typically overlooked.
Now brace yourself,
Oh, boy.
because we're about to enter a territory
Okay.
where Graham really lets loose.
Rigas.
He doesn't hold back
No.
when it comes to stock option warrants.
Oh, here we go.
From what you said earlier,
Yeah.
it sounds like he sees warrants
Yeah,
as public enemy number one
pretty much.
in the world of finance.
He does not like them.
All right, so let's get to the heart of it. Why is Graham so vehemently against stock option warrants?
All right. So he argues that warrants, essentially,
Yeah.
they separate and monetize
Okay.
the preemptive right
Mm-hmm.
of common stock.
Okay, remind me what the preemptive right is.
Okay, so the preemptive right,
Yeah.
it allows existing shareholders to
Right.
buy additional shares
Okay.
before new stock is offered to the public,
Right.
protecting their ownership stake.
Okay, so it's like a right of first refusal.
Exactly.
Okay.
You got it.
So warrants are like stripping away a valuable right
Yes.
from the common stock
Mhm.
and selling it off
Out
as a
live.
separate security.
As a separate thing.
Yep. It's almost like selling the mineral rights
Oh, yeah.
to your property
Did like that.
without telling the buyer.
Ooh, sneaky.
And this separation of rights can mislead investors.
Absolutely.
They might perceive the common stock
Yeah.
as more valuable than
Right.
it actually is
Yeah, it's inflated.
because they haven't factored in
The potential dilution,
that dilution again.
yeah, that warrants can create.
It's like looking at a beautifully renovated house
Okay.
without realizing
Yeah.
that the foundation is crumbling.
Oh, no.
Yeah, you don't want that.
And the irony is
Yeah.
issuing warrants doesn't even guarantee
No.
that the company will get that future capital right.
No, not at all.
There's no obligation for warrant holders
Nope.
to exercise their rights.
They can just sit on them.
So they can just hold on to the warrants,
Yep.
hoping the underlying stock price rises
Right.
and then sell them off
Yeah.
for profit.
Easy money.
without ever investing
Mhm.
additional capital
Yep.
in the company.
Nope. So it's like having a reservation
Oh, yeah.
at a fancy restaurant that
Like-
you might not even show up for,
Right.
but the restaurant can't give your table away.
Yeah. just in case.
just in case you decide to come.
So it's a frustrating situation.
It is for
Right.
companies, and this uncertainty
Yeah.
can actually hinder their ability to raise capital
Mm.
through future stock offerings.
It makes it harder.
They might need to adjust the warrant terms,
Sweeten the deal.
sweeten the deal,
Maybe throw in some free breadsticks.
yeah, for potential investors,
Right.
which further dilutes the value
Yep.
for existing shareholders.
Makes that pie even smaller.
It's a vicious cycle.
It is.
So this whole warrant situation
Yeah.
sounds like a recipe
Uh-huh.
for potential disaster,
It can be.
both for companies
Yeah.
and investors who don't fully understand the risks.
You got to know what you're getting into.
But I'm curious,
Yeah.
if warrants are so problematic,
Mm-hmm.
why are they even allowed?
That is the question.
And why do companies keep issuing them?
It's partly due to their allure for speculation.
Okay.
While we've been kind of highlighting all these dangers and pitfalls,
Right, right.
warrants, they can be incredibly tempting
Mm-hmm.
for those seeking like quick profits.
Yeah, the get-rich-quick crowd.
Yeah, exactly.
Mhm.
Because of their potential
Mhm.
for these like volatile price swings.
Yeah, yeah.
Remember, they represent that right to buy stock at a certain price in the future.
Right.
And if that stock price just, takes off,
Yeah.
the value of the warrant, it can skyrocket as well.
Oh, so it's the classic high-risk,
Yeah.
high-reward
Different
scenario. People are essentially betting on the future success of the company,
Yeah.
but without having to put up as much capital as
Mhm.
they would if they bought the stock outright.
Leverage, baby.
It's like a lottery ticket,
Yeah.
with a chance, however small,
However small.
of hitting the jackpot.
You got it.
And the book gives this captivating example.
Oh, yeah.
Tricontinental Corp. Warrants.
A classic.
These warrants, issued way back in 1929,
Mm-hmm.
rose from a fraction of a cent
Yeah.
to over $75
Can you believe that?
in just a few decades.
Wild.
Wait, hold on. From less than a penny to over $75?
That's the story.
That's an astronomical return.
Astronomical.
It sounds almost too good to be true.
It does, doesn't it?
What fueled that kind of price explosion?
It's a stark reminder, I think, that even flawed instruments
Mm-hmm.
can experience these periods of extraordinary price appreciation,
Right.
driven by speculation and market forces.
Yeah, yeah,
And in the case of Tricontinental,
yeah.
the company's underlying investments,
Mm-hmm. Yes.
they performed exceptionally well
Okay.
over those decades,
Right.
driving up the value of its stock
Yeah,
and consequently the warrants.
of course.
But, it's important to note that this kind of dramatic rise,
Yeah,
highly unusual,
right.
and not something investors should expect to replicate.
Of course, of
Okay.
course. It's like finding a rare,
Yeah.
valuable antique
Mm-hmm.
at a flea market.
You never know what you're going to find.
It's exciting, but you can't expect to stumble upon those kinds of treasures every day.
You can't go in looking for that.
Yeah,
Yeah.
exactly. And remember, the flip side of that potential for huge gains
Ah, yes.
is the very real possibility of significant losses.
Don't forget that part.
Warrants are highly speculative
Oh, yeah.
and can be incredibly volatile.
Up and down, you never know.
Graham also mentions the example of Ling-Temco Vought warrants,
Another interesting case.
which experienced a wild price swing in 1971,
A wild ride.
demonstrating the inherent risk
Yeah, it's a roller coaster.
involved.
Not for the faint of heart.
So after this deep dive into the world of convertibles and warrants,
Yeah.
what are the key takeaways
Mm.
our listeners should remember?
What have we learned?
What's the wisdom
Right.
we can glean
The gems
from Benjamin Graham?
from the OG.
First and foremost,
Yes.
caution
Mm-hmm.
and informed decision-making are paramount
Absolutely.
when dealing with these instruments.
You got to be careful.
Don't be swayed by the hype
The hype is real.
or the allure
Yeah.
of potential upside.
That siren song.
Yeah, without thoroughly understanding the risks.
Do your homework.
Scrutinize the fine print.
Read the fine print.
Assess the underlying security.
What are we really dealing with?
Yeah, and be aware of the potential for dilution.
That dilution, it's always lurking.
And never forget Graham's classic advice, never convert a convertible bond.
Words to live by.
There's strategic wisdom in holding on to that bond,
Yeah, it's your safety net
especially during times of market turbulence.
when the storm hits.
These instruments can be valuable tools for both companies and investors.
Absolutely.
But they require a discerning eye,
Yeah, a critical eye.
a healthy dose of skepticism,
Don't believe the hype.
and a deep understanding of their mechanics.
How they work.
As we wrap up this deep dive, I want to leave our listeners with a thought-provoking question.
Okay, hit me.
How do convertible securities and warrants impact the overall landscape of investing?
That's a big one.
And what could be the potential long-term consequences of their increasing prevalence?
It's a question worth pondering.
It is.
Especially as these instruments continue to evolve and play a significant role in the financial markets.
We encourage you to explore further.
Yeah, keep learning.
Perhaps examining specific convertible issues or researching the historical performance of warrants in different market cycles.
It's all out there.
Until next time, happy investing.
Happy investing.